Rohr here with an early concise highlight on Monday, July 28th, 2014. It's currently approximately 7 a.m. U.S. Central Time, and this is going to be very concise because so much of what's happening everywhere is still consistent with the global view that we put out on Friday morning. And there is quite a bit of macro influence that's going to become very critical later this week. However, there's just not that much out there today. So let's move on to what this actually means in practice for the technical structure and evolution of the market. Again, Friday we had some weakness that was not reversed by that better than expected U.S. durable goods, and the market sunk back below the key mid to upper 1970s highs that it had pushed above into the middle of last week. And on the gap lower on Friday, it also broke down below this channel, but that's again a more aggressive initial channel support. As we had noted, the broader channel support across time was going to be consistent with this Fibonacci level here about 1969, and the gap up out of last Monday into Tuesday from the 1966 close. And as you note, the top of this week, where is the channel support? It's right into about 1968. So with a gap back to this Monday close, even though the market would be nominally on a down break out of the channel below 68, our view is you probably have to get below 66 to put more pressure back into the other previous supports. You know, we were very keen before it even got there, going back as Janet Yellen started speaking back on the 15th. We were very keen about 60 and 50 as key support levels. The support reverts back to 60 now, which is also more or less a fresh Fibonacci support, and back to 50 as the ultimate support below the market. And with that, the resistance will be back up, of course, in the upper 70s to the close the market gap down from just above 1980 for now. And what's important here is the degree to which the short-term stochastic has attempted to turn up, even though the market's under just a little bit of pressure this morning, just slightly lower on the day, below 1971. Not really much movement there at all. And even the hourly stochastic, that can be more telling, looks in a position to turn up. And what we'll have to watch if this support in the 68 to 66 area is broken is whether the hourly MACD manages to leak out below its lower runaway band. And that's pretty much it for the short-term view on the S&P 500. And let's head over to the intermediate-term view on the weekly chart on the left and the daily chart on the right. And of course, one of the key things we were asking as the market was so quiet on its grind into a new high last week is whether the topping line and oscillator resistance, and the topping line was indeed right into 85 last week, and the oscillator resistance was 87. And this week, that topping line moves up to the 1990 level, and with a 41-week average that's up to 1858, the 135 over, $135 over the 41-week average now translates to 1,993. Now, two things very quickly on that before we look at the lower supports. One is, this is part of the reason that 2,000, although it may be psychological, is almost no technical resistance at all. If you're going to accelerate out of a 1990 to 93, chances are good you're not going to stop $7 higher. The next oscillator resistance, of course, is approximately another $30 higher. You'd be looking at something on the order of 2023 or something near it before you were stretched out on the oscillator again if you're going to go more than 135 over. And then looking at the supports, you can see why we're still so keen to keep an eye on 1950. 1953 was the overrun downside reversal from all the way back in late June. once it pushed above it on the first day of the month back on July 1st and the first day of the new quarter. We have a feeling investment flows and anticipation of decent earnings reinforce this push up. With some slippage, the mid to low 50s, 1950 in particular, has been a key support. Now we have to ask ourselves whether this is evolving into a broader pattern. Certainly if we were to get back below the mid 60s here, you can see how the market's going to be breaking the 9 and 18-day moving average. Daily MACD is already down. Weekly MACD could threaten to turn down. However, even with all those indicators pointing to potential weakness, the bears still need to knock out 1950, which was more or less the trading low back in the middle of the month, for one good reason. If it holds into this area, mid to low 50s, this could be evolving into a complex double left shoulder, head and shoulders, with the head up here, up into the 85 area, and any drop here that doesn't knock out 50 on a close, it's going to leave room to at least bounce back up to the mid to upper 70s to form the right shoulder. And in fact, if it's going to mimic the left side, this could end up being another complex right shoulder. It could take us into August in a quiet late summer market where it's very range bound between roughly 1950 and the mid to upper 1970s. So we'll be keeping an eye on that as well.